Club One, welcome to today's session. Let's just get right underway here. First thing though, starting on Thursday, just as a reminder, we're going to be moving from GoToWebinar over to YouTube Live. So it's going to be a little bit different structure. It's going to be new for me as well. So hopefully we don't run into too many issues, but it's very similar in terms of what you're going to experience as far as logging in and what you're viewing. But the links are going to be slightly different. What I'm going to do is under the weekly live online classes, this registration that we normally have, this typically you register this one time and it's got access to the webinars ongoing. That's not the same with YouTube Live. So what I'm going to do is, as I have each of the classes ready, I'll just provide a link right here that you can go to and click on it and log log in directly. There's also some other things. I'll post a little video on here once I get that up and going and show you how to set an alert on YouTube as well. If you like the meeting, you can get a notification through YouTube. I think it pulls up on your phone. So I'll add a little instruction on that before we get started on a Thursday. But again, it's going to be here in the Learning Center. You just click on Learning Center and then this weekly live online masterclass and then this webinar registration for that information. Let's jump in market conditions. Seeing a little bit of a reversal here today, not a whole lot, but we're at the upper end of the range here. We have been at the upper end of this range all year long, and really it got really extended, really since springtime. It's been in this upper range right here. Because of that, we've been relatively conservative with the overall size of the position, the number of positions, exiting out, the stop loss level, and I'm fine with that, just because I'm not interested in really aggressiveness at the top end of this range, and that's really, if we were to look at this chart right here, it's been most of this little piece. This is that 20-year time frame, and top end of the range, top end of this trend, historically, and sometimes if you've been doing this long enough, it's the once bitten twice shy scenario, and that is, that markets do not stay up here forever. Okay, we know that happens, and we know that those retracements can be fast, they can be painful, they can be a lot of times they're not. They may not be forecast very much as well, and we also have a lot of scenarios that we're talking about. It's really difficult in this day and age, with the amount of information that we have access to and the amount of perspectives and opinions that we have, and so everybody's got an opinion. Everyone thinks why this is going to do this or why it's going to do that, and so it becomes a little bit difficult just to hone in on ultimately what you want to decide and what you want to do, and to make a decision that's not necessarily based on everyone's perspective. So ideally, we try and provide just a data-based structure to be able to say, here's where we are. Do with that what you will. In this case, you could be very aggressive to the upside. You could be very aggressive to the downside. You could be flat. You could be sitting in cash. There's a lot of things that you can do, but it's also individualized on what you want for what your overall goal for your money and what your goals for the stock market are. You've got a lot of different ways to be able to do that. There's day trading. There's options trading. There's cryptocurrency, there's forex, there's position trading, there's swing trading, there's long-term buy and hold investing, there's Warren Buffett investing, and that is, you're buying the company, you're not buying the stock, you're buying the business. You could be buying dividend stocks. So there's a lot of different ways to do it, and those are different strategies. Those are different ways to ultimately try and get to an end goal that is your goal. It's not my goal, it's not anybody else's goal, and it has to obviously be realistic. We get bombarded with so many ads and so many perspectives of, do this, do that, turn this into that, and it really can be just a lot of noise, and say, what is it that I really want? What is it I'm trying to do? What can the stock market do that other things can't do? What can other things do that the stock market can't do? And vice versa. And we take that idea and we say, let's educate ourselves, and let's try and create a strategy and a methodology that can work for that method. So our long-term perspective obviously is going into that idea with what is the current market conditions. We want to start with this perspective so that we can then zoom in or fine tune the strategy that we may be utilizing as far as allocation or as far as the instruments that we're using, whether it's an ETF, whether it's an inverse ETF, whether it's just individual stocks but less of them, that our position sizes are a little bit different. And so we start out with this right here. And I say that because this last year, really the last 4, 5, 6 months, we've been relatively flat. We haven't had a fantastic performance. It hasn't been bad. It hasn't been great, but it's just been relatively flat. Part of that is because the market conditions are topping out. Okay, they're at a range that we're just not going to get much more out of this. We may get a little bit more, but we're not going to get a lot more. And part of that is, this scenario here, we're still dealing with, yes, the Fed is probably going to cut interest rates tomorrow. Everybody's anticipating, is it going to be a quarter point? Is it going to be a half point? The market already is anticipating a quarter point. If there's anything more than that, then the market may like that. The market may even be pricing a half a basis point. And remember that this matters because stocks ultimately, and companies, the earnings of companies are ultimately driven by a lot of different things, but when you have a consumer-driven economy that relies on debt, okay, we have credit cards, we have car loans, we have mortgages, we have, our Best Buy credit card, we have our Home Depot credit card, we have our Starbucks credit card. We've got credit, we just use credit, and along with that credit is the percentage interest rate that we're having to pay. A lot of times we as consumers are not super concerned until it's a car loan or a home loan, and we have to refinance and we're paying 6%. Right now our mortgages are typically at 2.5 or 3%. If we got any kind of loan in the last 10 or 15 years, they're fantastic rates. So you're just seeing a lot of different things that are still not great for the economy. The stock market's got to include all that. The stock market is nothing more than a live, real-time auction trying to figure out what the future prices of that auction is, or what the future perspective of, in this case, S&P 500 or stocks as a whole is going to do. So that being said, we also want to manage our risk. We don't want to be on the sidelines either, because our goal is to grow our wealth, grow and protect our wealth, utilizing stocks in a way that can be effective. Now, in order to do that, there's with our momentum style and trading just individual stocks, just to keep it simple, so that we're buying in at a certain point, we're using a trailing stop loss, we're exiting some of the shares on the way up, we're trailing the stop on the rest of those. Okay, it's a very simple method to be able to manage and maintain. We're not focused on any other things other than that. And in doing that, then we want to kind of have some indication of what is the stock market doing? Okay, is the breadth of the market, is the momentum of the market, is the sentiment of the market? So we've got this page here that has momentum, and we've got this S&P 500 chart. We know that this bullish trend, we've been trending higher, and the pattern now is going to be, are we going to break out here on the S&P 500, or are we going to get resistance right here at these levels? Markets typically don't have triple tops, okay? They do have double tops, but a triple top is not very common, okay? Especially if you have a higher low, it typically breaks out, okay? And so it's still a really bullish pattern right here based on today. That could all change in the next 2 or 3 days, and we'll see what ends up happening. But as far as this perspective, our long-term perspective, where are we at in the trend, in this long-term trend? We're at elevated levels, which means I don't want to be 100% allocated towards equities. I don't want to be 50% allocated. I want to be probably 25 to 35% allocated into equities, and then the rest in cash. Okay, bonds, if interest rates come down, bonds are going to be going higher. And so that's also, you get that asset class mix of, should I go with bonds or should I go with stocks, right? The percentage, should I go with cash or should I go with bonds? Right now, because cash is paying so much, in my opinion, it's a better place to have money in cash versus in bonds, even if rates are anticipated to come down, just because it doesn't move. You don't have daily volatility on cash. You have daily volatility on bonds, and a bond fund, it can outperform cash, but in the shorter term and allocation and where rates are at right now, there's nothing wrong with sitting in 3 or 4% annualized yield for cash. Okay, we can obviously do better in some ways, but we always have to take a little bit more risk. So let's talk about just our overall stock position, the market conditions now. Sorry, I'm scrolling a lot here. I wanted to come back to this and go with, again, this is that big picture. Where are we at in the trend? Upper end of the range. Do I want to be all cash, or do I want to be something inverse? Do I want to be hedging to the downside? Do I want to just be kind of doing what I'm focused on right now, and that is 25 to 35% equities, adding into each position each day, and using a trailing stop loss. Okay, so we've got a couple of things happening here. When we start to see, this is going to start to be interesting, because these are topping patterns that start to show up. We typically see this. Okay, we typically see momentum on the top when we do get markets topping out. We very rarely see sentiment at the top before a market turns. Okay, so we're starting to see some divergence happening here in sentiment. Okay, this is going this direction as the market is going higher. That means you're getting more and more players, big players in the market, that are not convinced, because this is kind of tied to VIX and volatility, and so you're getting the VIX is linked to S&P 500 put options. So when you get a large institutional buying of S&P 500 put options, then that additional buying moves the value of those put options higher. The extrinsic value goes higher. That's really what the VIX is it's measuring the extrinsic value of those S&P 500 contracts. Okay, so we're seeing more and more of that happening on that sentiment. So keep an eye on that blue line. Breadth is really good right here. Momentum, I think if we get a breakout, we're going to see a massive spike in momentum. I think that could give a nice little run. We're into September. October traditionally are negative months, so we could also see maybe a capitulation high and then some retracement. Hard to say, but where we are right now is in that bullish condition. Breadth is also bullish, and sentiment is high, but it is not as high as it has been. It's starting to fade, starting to lag just a little bit. We also have buy-sell ratio that is positive. Buy-sell ratio is up at 2.5. So we do have bullish market conditions. We also have S&P 500 sitting right here at these all-time highs and tagging that today. Okay, so we're getting some selling. I wouldn't be surprised to see some volatility here. I don't know that we'll get a ton of movement until we actually get the actual Fed to do what it's going to do. Everybody's sick and tired of talking and hearing about it, and just cut the rates already and get it over and done with, so that we can move on to a different perspective, and that is the economy, or inflation. The inflation's becoming less and less of an issue. It's going to be more about what is the economy doing, what are companies doing, what are earnings doing, growth, all those different things. But we're back into momentum with S&P 500 back above. Had a really nice reversal bar back in here inside of that 382 counter trend area at this 538 level on S&P 500. So everything's set up for more momentum to the upside until it's not. Okay, we can't ever say, yep, this is exactly the way it's going to happen, it's going to shoot here, because that's not what the stock market does. The stock market typically will fake us out in some way. But we had a little bit of a whipsaw here, not too much. It did retrace. We were stopped out of some things, but we're back into momentum. These patterns hurt momentum traders, because we get stopped out, and a lot of times we can't get back in time for to catch some of these lows. So this is, if you were to have an argument against just adding in and buying into something, it's not a very good argument. But in terms of managing and just buying and holding, these kind of moves for momentum, they create drawdown, they create stop outs, and that just happens. I would rather have those and deal with that versus any other method, or just holding on to something to the downside. So let's keep an eye on that going forward over the next few weeks, and see what kind of momentum we do get. We are at the upper end of the range. This is the 2-year chart. Momentum bounced to that 236 low, and we're back into momentum. Again, things are just elevated. What all that means is just use caution in the allocation, and even position set yourself for the next, think about the next 2 years. Think about the next 18 months. What does that look like? what is that? What do you need your money to do for you in that length of time? Do you need it for cash? Do you need it for XYZ, whatever the situation may be? And just paying attention to the amount of volatility that you're being exposed to currently. Let's jump over here to sectors, because we do have sectors have looked pretty decent. We've got all of them in uptrends now this week across the board. If we look at some of these returns, in technology has been the leader. What else have we had that's decent? Consumer, these are both about 3%. Industrials, real estate, so telecommunication, decent move that we've seen this week. And as a bulk, remember, we're just trying to tie all the pieces together. We're trying to give ourselves as many data points as we can to put the puzzle together. What is the trend doing? What are the market conditions doing? We know that energy is weak, but we also know that oil, let me go back to oil, that oil has really been getting beat up, but it may be bottoming out here just a little bit. I didn't want to go all the way out to that 2-year, but let's pull up that 2-year to see. You can see oil now down around that 618 retracement, still a bullish uptrend on a 2-year time frame, and just a deep retracement now down into this range. We'll see if we get that large counter trend move. It's just, lots of volatility. Lots of volatility inside of this range anyway on USO. 6-month time frame has moved back up above momentum. Okay, remember, the downward momentum works the exact same as the upward momentum. When we're connected this direction, here's our 236. Here's our corrective counter trend zone. So this would still be a bullish counter trend, but now it jumped out of that momentum, that downturn momentum, and it's up in this next range, that 72, 76 range for USO. That'll be the area to be watching. There's lots of resistance sitting right here at that 72, 73 range, and that could continue the acceleration to the downside on USO. Let's jump over. So that's kind of still our big picture perspective in terms of where are we at in the trend, what's happening in the shorter term. We've got some bullishness. Markets as a whole, S&P 500. Let's look at tech. Tech's been lagging a little bit here. Part of this AI move that we had, a lot of those stocks have not recovered fully, and they're making up. That's a big chunk of the Googles and Microsofts and Amazons. They had a pretty volatile couple of months here, and they're trying to gain some footing, trying to get some momentum back to the upside again here. And let's look at Dow. Dow has actually been the strongest of the 3 indices, and making a new high on Dow as well. So we're getting to new highs again, just lots of upside, lots of loftiness of where we're at currently in this trend. It doesn't mean we can't go higher, but it's just an area to where risk and allocation is going to be where we want to control some of that risk, control where we're at in those risk levels. Let's jump over and look at some stock ideas. Actually, let's jump over some ETFs and see what's happening here in the muscle ETFs group. We've got NAIL, which is the direction home builder and supplier bull 3x. So this is basically the home building sector times 3. So you're seeing some momentum there. Again, this is an area of the economy that, with lower interest rates, could start to spike again, or at least increase some demand. It'll be interesting to see if the prices that we're dealing with in homes, if rates come down and we start to see more supply, more sellers, and then we get lower prices on housing. That could be the case here. That doesn't necessarily mean that the building area is going to slow down, but if there's more supply of existing homes, then new home builders, some of those prices may come back down a little bit. That may affect some profitability here as well going forward. That's all conjecture, okay? That's all ho-hum, this, that. Price is telling the story as of right now. Price is saying we're back in momentum, we're back to the upside, we're breaking out of upside here as well. Interesting pattern on that. We're also seeing some of these gold miners. You've got junior gold miners, which is JNUG, okay, in this 1-year time frame. The gold mining stocks have not performed as well as gold itself. and they've been really, really volatile. We've had a couple of different trades, three or four trades that have been okay. I think we got stopped out of one. We had one that was a pretty decent winner. We're in another trade now, which is IAG. Currently in that trade. Let me go into the 6-month time frame. So we're back into a gold name here, which is IAG. Stop loss down at the low of 475. New entry bar right here. And again, this is the area ideally of momentum that we want to be paying attention to in trading. In fact, this was the last bar. I believe we entered here and either sold out or got stopped out of that one. And now we have an opportunity to jump back in. We'll just continue to do that until it stops working. But gold itself, in fact, let's jump over and look at gold. We had this breakout here, that 233 on GLD. It equates roughly to $2,300, $2,400 per ounce for gold itself. And typically gold moves higher as a safety net, as a move against some kind of downturn, weakness in the dollar, equity scare, systemic scare. I've mentioned this before. You got to have your gold, your guns, and your pork and beans all in your cooler, ready to roll when the zombie apocalypse takes over. But that's for a different discussion board, right? That's an interesting class out there of the doomsday world. It's always fun, I suppose. Everybody's got to have something to think about and focus on. But nonetheless, gold has been around forever. It's not going anywhere. It has a intrinsic value of store value versus money versus dollar bills are just the full faith and credit of the U.S. government. It's just trust. Okay, do we trust the backing of this, or do we have something that we can put our hands on and hold on to a bar of gold and know that I'm going to get real value out of that? It doesn't mean that it can't go down in value. People can obviously sell that, but it's just a little bit different perspective when you're dealing with allocation. And it's the same thing there's so many things these days. You've got art, you've got cryptocurrencies. A little while, back in 2020, you had NFTs. Those have kind of fizzled out. You have, Jordan shoe. You got shoes, Nike shoes. Like my 12-year-old son, he's, you got to collect these shoes. You got to have them, and you can buy them and sell them. You can trade them, and it's just a fascinating thing. You can, there's always value in different things that we can buy and sell. I think it's great. I think it just allows for more opportunities to collect things and to collect things of value that aren't necessarily just crap, and that we could sell those and they hold their value. Just kind of the side discussion here with gold. Let's jump over. Let's look at a couple of trade setups here just as a refresher. Okay, let's look at PLSE. Okay, let's say we've got our top-down approach. We're looking for entry. We've decided that we're still bullish. Market conditions are good, okay, because we've got momentum back into the upside. We've got breadth back to the upside. We've got buy-sell ratio, which is positive or above 1. Okay, those are the market conditions that we would want to consider and say, all right, I think that I would go ahead and add into a position. What kind of position do I want? If I wanted to go really on any of these, if you look, most of these are built on a hold to buy signal, except for this one. The sell to buy, in most cases, is the first buy signal after a sell signal, but if it's already highly ranked, it's got to go from hold first in most cases. So the new buy scan is a great place to start in looking for some of these. And as we've talked about before, we can fine tune that down if we want to say, I want something that's got maybe a little bit more volume, okay, or something that's giving me a little bit different perspective. I can create a little bit more, again, just a filter to be able to zoom in on less stocks and give me some criteria to be able to focus on. Here, if I've got my entry, okay, so again, our setup pre-market, this is an end of day system. So we're just focusing on one bar at a time. Each bar represents one day, and we're not going to make any changes during the day unless we get stopped out of something. Part of the reason for that is that most traders and investors just overtrade and just overdo it, and watch a ticker all day long and watch the chart and drive ourselves crazy, and it just doesn't add to a systematic type of methodology. So this is built just so that it helps remove a lot of the moving parts, so that you've got one thing to look at, and that's it. You've got to make a decision off that one thing. And in this case, that one thing is our confirmation bar has now moved higher on the day. It's moved up above this 236, which is that momentum zone. Again, the momentum zone is this area. When stocks start moving higher and they get into those momentum zones, let me just actually do this little practice right here where we go back a little bit. Let's pull up the 1 year and let's go back a little bit like this. Okay, so here's about where we are at right now. A stock, it's moved higher, it's in momentum, and it's gone higher. Now, this is an area where a lot of people are like, gosh, I'm looking at this chart and it's gone from here, it's gone from $5 to $14. Should I buy it? Well, maybe not right here, but should I anticipate more upside? The idea of momentum trading is that we expect this stock to continue to go higher. Okay, and when it doesn't, then we have stop losses in place so that we're exiting out. Okay, so once we start to get into this momentum zone, it's going to react typically around a prior support area, and oftentimes that 236 becomes a powerful support area, and then we're looking for more upside. Now, if it doesn't happen, when we start to break down like this, we're going to say, I've got to get out at some point. Okay, I've got to stop out, because what I don't want to do is, oh, is it going to go up? 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 Okay, and so just like this, we're asking ourselves that. Eventually, if it's a good company and it's around and you're just like, I don't even care what it does, I'm just going to buy this stock because I know what it does and I'm confident that it's going to go higher, then I'm going to buy it, and in 10 years I'm going to look at it. If that's the mentality, then yeah, just buy it and let it do what it's going to do. That's kind of the Buffett style is, you got to be okay with a 50% loss. And that's one of the things Buffett has said is he's okay with a massive loss. He typically doesn't have them because he's such a good stock picker in terms of buying the right business at the right time. But this is just what we're focused on is we only want it if it's going to continue to the upside. If it doesn't continue the upside, then we're going to stop out. In this case, we would have been stopped out. Now we're out of the stock. Now we don't have to think about it and wonder what it's going to do and when it's going to bounce. At some point, now we get some earnings and some gaps back up again. Now we can re-enter onto that gap if we wanted to, or give it a day or two. Okay, but now that momentum is back again. We're starting. You can see where it's reacting. This is a pretty volatile stock, so we would have been up and down on some stop outs along the way. Okay, but this momentum zone, when we're saying where is it reacting and how do we want to be able to focus on this, and now this is where we're at right here. Okay, so it's gone and it's been pretty volatile this last range, but we've gone from where we were looking at that breakout. Now that breakout doesn't look that significant. Okay, and 2020 hindsight, we're saying, gosh, why didn't I buy it back here at 11, 12? Now it's at 20. Okay, so don't let that become a factor of missing out on opportunities because the stock may feel high. Now, that being said, they do come back. They come back to earth, and these kind of stocks can come back to earth pretty quickly. We know that, and just have to always make sure that the stop loss is in place. Okay, now what we want to do here, we've got our entry, and we're setting up our risk profile to say how many shares should I be adding in. In this case, this portfolio size is 116,000, and I want to do 2%. So what does 100 shares look like? That's 1.7. Let's go 120. Let's go 110. Okay, I'm at 195. Let's go 112 and see what that looks like. So 1.98. That'll get us pretty close. We're at 2%. That's $2,000, $2,300 at risk. That's without a stop loss. Okay, so now I want to define where am I going to get out if this stock goes down. I don't want to say if I'm wrong, but if the stock moves lower from here, then it just moves lower. Okay, there's nothing we could have done about it. There's nothing we can do about it. So why should we be wrong? Why should we say it's wrong? It's just not. It just didn't work, and that happens most of the time, 50, 60% of the time, they're not going to work. We're going to get stopped out of them. And the rest of them are going to continue to move higher. So in this case, we want to define where that line in the sand is. We define it way below this low point. Okay, now we have two scenarios. We can go deeper stop losses, or we can go a little bit. The deeper the stop loss, oftentimes the smaller the position size. Okay, so let's look at that. If I go 112 shares, because we're dealing with two numbers, I want to add this stop, and let's put it at 1650. So 1650, that puts me at 0.39. Okay, we want to be ideally at 0.3 or less. So it's a little bit high right here. Two things I can adjust. If I want to keep my stop loss right here, the only thing I can adjust is my number of shares. So I've got to come down to get that closer to 0.30 with the number of shares, 80 shares, 0.28. Okay, now get rid of my stop at 1650. That lowers my position size. So I have to take a smaller position size in order to have a wider stop loss. If I want a tighter stop loss, if I want to keep that position size at 2%, I'm going to have a tighter stop loss. Tighter stop loss just means the stop is closer to your purchase price than where it was before. Okay, this is a wider stop because if my purchase price is here, this is a long ways down for it to travel, versus here, it's only going to travel to here. So this is increased loss if I've got a wider stop. So I want to be able to control that by making sure that if I have 1650 and this is my number, I'm sticking to it. Okay, that's a pretty wide stop. Instead of doing that, if we go back to the 110 shares, I think we said 112. Let's go 112 shares, and we come at, let's go right below this low. The low right here is at 1830. So if we go 1830, that puts us at 0.22 and a 10% stop. Okay, it's a tighter stop loss right here, which means that if it traded back down, it could attempt that, and it could slice right through and hit that stop. Okay, exit it out of the trade and then reverse back up. That doesn't matter. The future doesn't matter, versus the thing that matters the most right now is this number. Okay, what is my risk? How much could I lose if it did drop lower? That's what I want to be more concerned about, versus what does the upside look like? The market will take care of that for us. If it's going to go up, it's going to go up and we'll make some money. But if it's going to go down, then it could also go down and we could lose some money. We want to know we want to define that just so that we have some structure over the amount that we've always got at risk. And that's our 250 right here. So that's the setup. In fact, that's the setup I set up this morning, and with that very same number of shares. So that's your setup for entering into a trade. You can do that based on your market conditions, and then just pick your stock that you're going to be going to. I like those ones that are close to the 236 and have increased volume, like we've got right here. Let's see if there's any others. That one's a little bit far into the move. It's still okay, but ideally we want, and gaps are a little bit tougher, especially if it's a huge gap. A lot of times give it a day or two. Sometimes, God, there was a couple stocks. In fact, it was this one. Let's see if it's Summit. So Summit had this gap higher from 11 to 16, and that was a 50% day. It went up 55%, and from there it went up another 100%. It's just been a crazy move. And these gaps, okay, so you get a gap that looks like this, and you're thinking, there's no way I'm going to touch that one. But there are times where it just keeps going and going and going and going. Okay, so don't let a gap deter you, but sometimes it's a little hard to define the risk on those because of the size of the gap, because it can retrace. We've seen that happen over and over again too. It gaps up to 30%, and then the next day it moves back down by 30%. And it can be a really painful stop out if it does reverse on those big gaps higher. Let's jump over here and see some of those in the new buy list. If they're a little deeper in the trend, they still may be new buys and they're ranked higher, typically because they've had a big move on the 1 year time frame. So this has had this big 1 year time frame move. My 6 month time frame, we'll scroll through that. Like this one here, that'd be another interesting setup based on this bar. Increase in volume at the 236 location for entry. This one is not a fantastic bar. Ideally, we want to see it moving higher. When it's black like that, it just means it's a down day, it's a red day. It means there's some weakness in that. Plus, there was not increasing volume on that day. So I would skip over that one because I want to have higher volume going into the day here. Here's a good example again, near the 236, confirmation bar, increased volume, increasing over the prior day. That's telling you that there's more interest, there's more demand, there's people that want to buy it, and it's pushing the price higher. That means that there is demand, and that momentum is what we're interested in. We want to see it continue to move higher from there. Okay, here's one that was a little bit upper, a little bit high in the trend here, away from the 236. It can retrace and come back down. So even though it's moving into momentum, that may be one that we want to give a little bit of time on. Here's one as well. Not a real good clean bar. Volume is declining or wasn't increasing over the prior day. Let's skip through that one. I'd skip through that one because it's too far away from the 236. That one's too deep in the trend. This one's not too bad. Here, this bullish day, lower volume, had increasing volume on the day before. And this is a nice one here. You've got nice confirmation, good clean bullish bar here near the 236, because that means it's earlier in the trend and you've got increase in volume. Those are pretty easy criteria when you're to just look through when you're looking through this new buy list, because there are a lot of candidates, and then ideally keeping your rank above 80, even keeping it above 90 is helpful. I'm going to end on that note. Thanks everyone for your time and effort, and we'll see you next time. Bye now.